we're going to begin Accounting 101 with getting a basic understanding of what is accounting and why is it important. Why is it that you are here studying accounting? So first let's understand what exactly is accounting. Accounting is important because it helps us to identify, record, and then communicate what happens in a company. So let's think about it this way. First, we have to identify what happens. And when we're identifying something, we're going to focus on what we call as a transaction, and we'll get into what those exactly are. We're then going to record our transactions, and we'll do that using our specific accounting rules that we're going to learn as we move forward. And then we're going to communicate our results. We'll communicate our results mainly through what we call our financial statements, and we'll learn how to put together financial statements as we move through this class. When we communicate our results, we're going to communicate to both internal users and external users. So let's talk about the difference between the two. External users are typically people outside of the company, whereas internal users are people inside the company. Now, as a basic rule, we said external is anyone outside of the company, but to get a little bit more specific, it's anyone who is not involved with the day-to-day running and decision-making of the company, whereas internal are people like the CEO or managers who are making decisions. It's very important to have an understanding of accounting because there are many, many opportunities in the accounting field. What you can see on this slide is actual careers related to accounting, but even if you go into a career that's not directly related to accounting, as long as you have a basic understanding of accounting principles and rules, it'll help you as you move forward in your career because you can begin to understand how a business reports and what's important. So let's look at some of these specific careers in accounting. The book does an excellent job of going through all of these, so I'm just going to touch on them. We have financial opportunities in accounting, and this is where you're typically looking at the people who are either preparing or working directly with your financial statements. You then have managerial opportunities, and this is typically looking at managers in a company who are using accounting information in order to help them run and make decisions for the company. You then have taxation. This can be people who work on preparing the taxes for a specific company, or you can look at the authorities and the governmental people who work on taxes. And then finally we have accounting-related fields. And this is people who are not necessarily involved with creating or using the financial statements of a specific company, but they're using different information to help them make decisions, whether it's something like lending money to a company, consulting with a company, and so on. So as you can see, there's lots of opportunities within accounting, and that's why it's such an important field to have an understanding of. This slide we have a basic little quiz that we can look at together to make sure that you understand the difference between internal and external users. If you'll remember, I said an external user is anyone outside the company or someone who does not directly run the company, or an internal user are those people who create the finances and they use them to make decisions for the company. So let's look through these. A regulator, this is generally when we're talking about someone in the government who helps regulate a typical field. So this would be an external user. Maybe it's tax regulations or some type of environmental regulations. So they're external to the company. The CEO, that's the Chief Executive Officer, they're internal. They're going to be using finances to help them make decisions for the company. A shareholder. This is someone who has ownership in a company, but they're not involved in the direct day-to-day operations of the company, so they're going to be external. You have a controller and an executive employee. Controllers and executive employees are people who make decisions about the running of a company, so they're both going to be internal. We have an external auditor. Right there you can see that they are external to the company. That would be opposed to an internal auditor. We'll get into auditing later, but just keep in mind, because they are external, they are outside of the company, and so they're an external user. A production manager. This is important because this is a production manager, someone who is managing the company, and therefore they're using accounting information to help make decisions about the company, so they're internal. And that's opposed to a non-executive type employee. The production manager is an employee, and they make decisions about the running of the company based on accounting information, so they're internal. But a non-executive employee, someone who is simply working there, they're not helping to run the company. Although they are very much involved with the company, they're not running it. So we're going to give them an external user qualification. In this next section, we're briefly going to touch on ethics in accounting. But I want to note that ethics is very important. If you'll remember in the past, and if you think about news scandals and things that come about, when we talk about a lack of ethics in the accounting world, that's when we're talking about something fraud going on within a company. And fraud is detrimental because many people invest in different companies, and they invest in a company based on decisions that they make which are based on a company's financial statements. So if people, or the people who are putting together the accounting records and the financial statements for a company, are not acting ethically, that's how we get involved with fraud, where people are making financial statements that are untruthful, and that can hurt many people, whether they're people investing in a company or simply the employees who work for a company, because when it happens that there's a large fraud, and you can see this through examples like companies like Enron and WorldCom, those companies end up going out of business, so people end up losing jobs. If there were pension plans or 401ks wrapped up with the stock of those companies, people can lose all of their retirement savings and their pensions and things like that. So we're going to touch on ethics now, but it's going to be a theme throughout the rest of this class that we'll mention, talking about ethics and why ethics are important. So moving forward, anytime we're talking about ethics, we're talking about distinguishing between right and wrong. Ethics are even a higher standard than whether something is legal, because something may be legal, but it may not be ethically right or wrong. So anytime you're talking about people's money and their investments and their financial well-being, we want to focus on making sure that our decisions are legal and that they're ethical. So when we're talking about financial statements and accounting, we need to make sure that we are always looking to identify any ethical concerns, and this could be whether or not someone's making a certain accounting transaction correctly and things like that, and we'll talk about how some unethical things could come about as we move forward. You'll need to analyze all your different options. You're looking at both the good and the bad consequences, and then hopefully you can make an ethical decision. And that means that we'll choose what is the ethically correct and legal decision, even if it doesn't suit us personally, as long as it's the more ethical decision. That's the decision we want to make. So I now want to introduce something that we call the fraud triangle. And the fraud triangle is the idea that in order for a fraud to take place, there are three factors that must be present. There has to be the opportunity, the pressure, and the rationalization. So let's think about this. The opportunity means that someone wants to commit a fraud or someone wants to steal. If there's no opportunity, then it simply cannot happen. So if you think about someone working as a cashier, if there is no way that they can take money, for example, let's say they don't have a key to get to the cash, then there is no opportunity for them to steal. There also needs to be some type of rationalization. And rationalization is how someone in their mind says, yes, this may be stealing, but I have a reason that justifies and makes it okay for me to do so. And a typical rationalization that we see is employees who maybe feel that they're not being paid enough. So they feel like the fact that they're stealing from a cash register is justified because the company's not paying them enough. So that's an example of how someone might rationalize a fraud. And then also there has to be some sort of financial pressure or reason. Typical people won't steal money or take that risk unless there is a pressure that seems to be forcing them to do that. So, for example, if you have a parent who has young children in a home and they're not able to pay their heating bill, someone who is under that type of financial pressure where they have something that's very important to them, the welfare of their children, they're much more likely to rationalize and take advantage of an opportunity to commit fraud. We're now going to begin looking at the rules and the principles that define financial accounting. So when most people think about accounting, they think about assets, liabilities, or they think about debits and credits. But before we can begin learning our specific rules, we need to learn the principles that help to set up those specific rules. So we're going to look at what we call generally accepted accounting principles. And I'm typically going to refer to generally accepted accounting principles as GAAP, and that's just an acronym, GAAP, Generally Accepted Accounting Principles. And these are simply principles that help define what it is we want to accomplish with financial accounting. So financial accounting is governed by concepts and rules known as Generally Accepted Accounting Principles. Right here, that's GAAP. And GAAP aims to make financial information that is relevant, reliable, and comparable. So anytime we are creating financial accounting rules, and that's what we'll be learning when we start looking at debits and credits and all of that, we want to make sure that our specific rules help uphold these different principles. So we want to make sure the information that we're providing through financial accounting is relevant. And that means that the information has an effect to our decision makers or our users. We want to make sure that our information is reliable, meaning that it can be trusted, it is true. And then we want to make sure it's comparable. And when we talk about comparable, we want to make sure that our information is set up in a way that a user or someone who's looking at investing in our company or maybe lending money to our company can use our financial statements to compare it to other companies to help make a good decision about whether or not they want to invest or loan money with our company. So information has to be relevant, reliable, and comparable. When we talk about GAAP in the United States, we are talking about rules that are put together by what we call the FASB. That's the FASB. The FASB is a board that puts together our specific GAAP rules. And that's here in the United States. However, because today's world is becoming more globalized, the FASB, which again are the people who write our GAAP rules here in the United States, are trying to make sure that their rules are becoming more and more similar to international accounting standards. And those rules are written by the International Accounting Standards Board. That's the IASB. Those are fairly easy to remember. So the FASB is here in the United States. That's the Financial Accounting Standards Board. And they write GAAP for the United States. And then the IASB is the International Accounting Standards Board. So as we move forward, we're trying to make sure that our United States GAAP, written by the FASB, is similar to international accounting standards. Because remember, one of those principles that we want to help uphold is comparable. And if United States companies are to be looked at along with international companies, we want to make sure that we are accounting for things that are similar in a similar way and similar principles. So we want to make sure that they're comparable. And we're doing that by helping converge FASB and international standards. So the FASB and the IASB are attempting to converge and enhance what we call the conceptual framework. And the conceptual framework is just a framework that helps guide standard setting. In standard setting, we're talking about the specific rules that we follow when we're recording accounting transactions. So again, the FASB and the IASB are trying to converge and make things more similar. So we want to make sure that the two have similar objectives, That means that we both, the IASB and the FASB, want to provide information that's useful to the investors, creditors, and other users. We want to have similar qualitative characteristics, and that's where we talked about the fact that information needs to be relevant, reliable, and comparable. We want to make sure that we have the same elements, and elements are simply what we define as items that are in our financial statements. And then we also want to have the same rules for recognition and measurement. So for criteria to be in the financial statements, it needs to be an element, and we need to make sure that we agree, that means the FASB and the IASB are converging and making sure that how we measure and recognize those elements is similar. So moving forward, we're going to continue looking at some of these underlying principles and assumptions that help make up the rules or the foundations for accounting principles that we'll be learning as we move forward. So we have our general principles, and these are the basic assumptions or the underlying principles that help us to prepare financial statements. And we'll look at what some of these general principles are as we move to the next slides. And then we have our specific principles, and these are the detailed rules that we use in reporting business transactions and activities. So when the general public thinks about accounting, that's where we think about all the nitpicking, whether something's a debit or a credit and those things. So that's what we're talking about, these specific principles. But before we can learn the specific principles, you first need to understand the general principles. Because if we can understand the general principles and the foundations of accounting, we can understand why we have the specific principles that we have. So let's move forward and look at some of these accounting principles. First, we have the measurement principle or the cost principle. And this simply tells us it's a principle that says accounting information is based on actual cost. And I just want to identify exactly what we're talking about. So if you're looking at how are we going to account for a piece of land, if you think about it, land generally increases in value over time. However, based on our measurement or our cost principle, we need to account for a piece of land based on its actual cost. So rather than what we actually think it's worth because the value has increased over time, we need to account for it by what it actually cost us. And that all boils down to the fact that if you'll remember, our information needs to be relevant, reliable, and comparable. So for information to be reliable, we need to make sure we're doing the actual cost, because even though we think the land may be worth more, that would be an estimate and it's not necessarily reliable. What is reliable is what it actually cost us. So again, that's how all these principles and foundational rules go together to help us then come up with our specific accounting rules. Our next principle is the revenue recognition principle. And at this point, some of these may seem a little intangible, but as we move forward throughout the class, we'll go back and we'll look at these principles and how they help us to come up with our specific accounting rules, but we're just going to go over them briefly right now. So the revenue recognition principle means that we recognize revenue when it is earned. And what does that even mean? Let's think about a company. Sometimes a company has people pay them in advance. And what that means is that they're getting cash before they have actually done anything. So therefore they have not actually earned that money. So they have not earned money. So we do not recognize revenue until we have actually earned that revenue. And we'll look at how that actually happens as we move forward. Your proceeds do not necessarily need to be in cash in order to recognize revenue. And that means maybe we'll get a promise to get cash in the future, kind of an IOU. And when we look at those, we'll give a specific account name for that. And then also we're going to measure our revenue by the cash received or the cash value of items received if we receive something rather than simply receiving cash. On the other side, we have our expense recognition principle, and the expense recognition principle or the matching principle goes along with our revenue principle. And this tells us that a company needs to record its expenses in the same period in which they helped to earn revenue. And we'll go through this in more detail as we move forward. And finally, we have our full disclosure principle. A company is required to report the details behind financial statements if that information would impact a user's decision. And we'll look at what some of those full disclosure principles are again as we move forward through the class. So again, this is just a brief introduction of some of these principles, and then as we move through the different chapters, we'll focus on how these different principles affect the specific rules that we actually are going to learn and use. We're going to look at a couple basic accounting assumptions, and these are assumptions that back up the accounting rules that we're following when we're recording transactions for a company. So the first assumption is that when you're looking at someone's financial statements, you can assume, unless it's otherwise stated, that the company is what we call a going concern. And a going concern means that we can assume that the company, the way that it's operating, is going to continue operating in the future. Next, we have a monetary unit assumption. The monetary unit assumption is just simply the understanding that we are reporting things in some type of monetary unit. For example, in the United States, it's typically in the dollar. If you have companies that are global companies and they're reporting transactions from all kinds of different countries, those specific countries are going to keep their financial statements in whatever monetary unit they use. However, then when everything comes together for the parent company, it'll be put into whatever that parent company's monetary unit is. So if it's a company here in the United States, we would then transfer everything from, for example, the Japanese yen, we would transfer it to the dollar. Or if it was European money, we would transfer from the euro to the dollar. So the monetary unit assumption is just that we're talking about things in terms of some form of monetary unit, typically the dollar here in the United States. We have the time period assumption, and this is just the assumption that we are going to record accounting transactions over a certain period of time, and that the life of a company can be looked at and divided into equal time periods. When you're thinking about time periods, most people think about our normal calendar year. So the year begins on January 1st, it ends December 31st. Companies also report things on a monthly basis or a quarterly basis, and those are all different types of time periods that can be used. Finally, we have the business entity assumption, and this tells us that no matter what the business is, we want to assume that the business is separate from the people that own or run the business. On the next slide, we're going to look at some different types of business. And I want to note that even if someone has what we call a sole proprietorship, meaning this is your personal business, you don't lump all of your personal business transactions in with your personal money. So for example, if you have your own checking account where you pay your mortgage and things like that, you're not going to lump your business transactions in with your own personal bank account. We'll keep them separate. And that's because of the business entity assumption, saying that the business and its owners are separate. So let's look here. We've got some different types of companies. We have our proprietorship, and that's what I mentioned on the previous slide. Many people call that a sole proprietorship, meaning this is one person that owns and runs a company. You then have a partnership. This is where two people work together. And you can have a corporation. So these are three basic types of companies, but I want to note that there are many other types of companies. These are just some basic ideas. So let's look at some of the major attributes of proprietorships, partnerships, and corporations. So the biggest thing here is that a proprietorship or a sole proprietorship, you only have one owner. So you can see here that's just one owner. A partnership, by definition, anytime you partner with someone, there's more than one person. So a partnership does not have one owner. A corporation, this throws a lot of people off. People think of a corporation something like the Coke Corporation or Apple Corporation. In those cases, you have many owners, and the owners are the people who own the stock in that company. But just because something is a corporation doesn't mean that there have to be many owners. One person can own all of the stock in a company, or the stock can be owned by many people. So a corporation, even though most people think of a corporation having many owners, it can have just one owner if there is one person that owns all the stock. So let's look at taxation, and this is a very important issue when it comes to deciding how you're going to set up a company. So is the business taxed? If it's a partnership or a proprietorship, the business itself is not taxed. The way that the government makes money off of proprietorships or partnerships is that they tax the income that the owners receive. On the other hand, a corporation, the corporation's income is taxed. So for example, if you think about Apple or Coke, whatever they show on their income statement, they are going to be taxed based on the income that they make. I also want to note something very important about corporations is not only is the business taxed, but then the owners who receive dividends or monetary payments from the corporation, those owners are also taxed on those benefits that they receive on those dividends. So I want to note that anytime we're talking about a corporation, the owners or the shareholders of a corporation have to deal with something called double taxation. And that is the fact that their corporation that they have ownership in is taxed on its income, and then that when the owners receive dividends, they are then taxed for a second time. So that's double taxation. Let's look here at limited liability. When we're talking about liability, we're talking about the fact that anytime you have a business, you can be held liable for mistakes that you make or problems that your company encounters or creates. And that's talking about the legal liability that you may have to pay someone if you're sued for some type of mistake. So let's look here. When we say limited liability, if you limit your liability, that means that you as an individual are not liable. So let's look at this and we'll describe it. Note here, a proprietorship and a partnership, they do not enjoy the benefits of a limited liability. So let's look at this. If you own a proprietorship or if you're a partner in a partnership and the company that you have does something wrong, let's say you made a ladder and it was faulty and someone is suing you because they broke their leg on that ladder. Not only can your company be sued, but you as an individual can be sued. So if someone's suing the company for a certain amount of money, let's say they need $1 million, but the company does not have $1 million to give them, that person can take the money that the company does have to fulfill their lawsuit, and then whatever's left over, they can then come after you as a partner or a proprietor. On the other hand, a corporation, think about the Apple Corporation. If they are sued, it is the corporation that is sued. It is not the owners. Because if you think, many people own stock in Apple or in Coke, but they really don't know anything about the decisions that the company is making on a day-to-day basis. So you don't want to be sued for something that you really have no control over. You just have a small investment in that corporation. And that's what we call limited liability. As a stockholder, you have limited liability because only the corporation's assets can be sued, not your personal assets. I want to note here, you'll see this asterisk beside the limited liability that proprietorships and partnerships lack. There are two other types of companies. Those are LLCs and LLPs. LL in those stands for limited liability. So you can set up a limited liability corporation or a limited liability partnership in order to help limit your liability if you don't want to be a full corporation. And there's a lot of specifics that go into that. But do be aware that there are certain forms of business besides just the corporation that do have parts of this limited liability benefit. The business entity. The business entity, if you'll remember, that's one of the assumptions we looked at the previous page. No matter what type of business you are, a proprietorship, a partnership, or a corporation, The business is separate. So even if you're the sole owner of a company, you'll want to keep your business books and your personal finances separate. Let's look here, a legal entity. We talk about a legal entity, and that is the only thing that we look at for a corporation. A corporation is its own legal entity where the proprietorship and the partnership, they are only an entity as long as they have the people that run them. Then let's look here at unlimited life. Unlimited life means what happens to the company if someone dies. So if you have a proprietorship and the sole proprietor dies, the company goes away with that. That's the same with the partnership. If your partners die or if one of the partners die, typically the company goes away. Now, there can be different contracts, or if someone has willed the company to another person, that the company does not in fact die, but again, that's all contractually based. On the other hand, a corporation is typically owned by many different stockholders, or even if it's owned by a single stockholder, the stock can easily change ownership. So if the owner of that stock dies, you can simply change the ownership to someone who maybe the stock is being willed to someone, or you could simply sell it to someone else who's interested in buying that stock. So just because someone dies, you don't have to worry about the life of a corporation because it is not affected by the life of its owners. As we finish the first half of Chapter 1, I want to briefly introduce a couple of different congressional acts that have had a big effect in accounting in the world of finance lately. The first and one of the largest of these acts is what we call the Sarbanes-Oxley Act. And this was an act passed by Congress in order to help curb or stop financial abuses by companies in order to help protect the stock in which the public was investing. If you'll remember, and I mentioned it once already in this chapter, in the past and in the early 2000s, there was a downturn in the economy, and along with that downturn, a number of frauds came to light. A couple examples of those would be Enron and WorldCom, and in these frauds, people were making financial transactions that were incorrect. They knew they were incorrect, so these were fraudulent. And not only that, but their auditors were also seen to be not doing the correct things and not being stringent enough on these companies. So the government decided to step in, and the first thing that we had is the Sarbanes-Oxley Act. The Sarbanes-Oxley Act is a very large act, but some of the things that we're going to talk about in this class, and one of the most important things, is that Sarbanes-Oxley really focused on making more stringent internal controls. And that means that companies are now going to be more responsible for putting together an internal control system. We'll look at specific internal controls as we move forward, but in internal control are controls in place that help prevent people from having the opportunity to move forward with the fraud. Remember, we talked about the fraud triangle. So here with internal controls, we're trying to get rid of that one leg of the fraud triangle, which is the opportunity. So internal controls should help to give less opportunities because it's going to control what people can do. So one thing that SOX brought about was more stringent internal controls, and not only that, they're also going to look at management now has to make a report on their internal controls each year, and then their external auditors also have to review the management's report on internal control. They also brought apart more transparency and accountability, and hopefully along with that truthfulness in financial reporting. I also want to note that now, if it's found certain frauds come to light, not only can CEOs end up paying large amount of sums in penalty payments, but also CEOs in this type of white-collar crime or fraud, you can actually be sent to jail for these types of crimes, thanks to Sarbanes-Oxley. We then have the Dodd-Frank Wall Street Reformation and the Consumer Protection Act. These are also acts that came about Anytime the economy turns down, frauds and problems are generally brought to light, because that's when they're found, because the frauds quickly begin to kind of crumble and the mistakes begin to show. So these acts brought about financial accountability and transparency. It helped put an end to the notion that certain companies were too big to fail, and it helps to protect taxpayers by ending all of the financial bailouts that were going on during the 2000s. And finally, we're looking at how to protect consumers from abusive financial services.